So now let us discuss some common risk management strategies. Of course, different types of risks will be managed using different types of strategies. But in general, not only in case of Islamic Bank, but in general, what are the common strategies that can be used to manage various types of risks? Number one is diversification. Normally, business organizations they invest in multiple assets. Rather than putting all the money in one place, they usually invest in different types of assets so that their risk is spread away among different assets, because that all assets do not respond to a shock equally. If something bad happens, then not all assets will behave in a similar manner. So if the Islamic Bank invests in many assets, then what will happen? Ultimately, the overall risk will be diversified. So this is one way. So this is actually the reduction of unsystematic risk by investing in a number of different assets, rather than investing all money in only one or a few assets, investing in many assets, so that maybe negative outcome of one asset will be covered up by the positive outcome of another assets, and we are not exposed to very high risk. Okay, this is one way. Another way is hedging. Hedging means eliminating uncertainty by entering into a counter agreement, some kind of counter agreement, so that the loss of the first agreement will be mitigated by gain in the other investment. So in that case, you can understand that if you want to eliminate or reduce the risk of one asset, you have to invest in another asset having opposite characteristic. Okay, so that the loss of the first asset will be mitigated by the gain of the second one. So why the second one will provide gain when the first one is giving loss? Because at first we have said that these two assets have opposite characteristics. So in the same situation, when the first one provides you some profit, the second one provides you some loss. Okay, so this is called hedging. Then another one is insurance. So you understand about insurance, like life insurance or motor car insurance or this kind of thing. But we can also have insurance for financial products for eliminating the risk or for spreading away the risk of financial products. Okay, so what happened in that case? In that case, maybe regular there will be some kind of regular insurance premium or payment, but whenever there is an incidence of loss, that insurance may cover that loss. Okay, that is one benefit of insurance. And the benefit is, that not always you are encountering a very loss situation, a very big loss situation. So only in a few cases you will encounter that. But everyone is always paying the insurance premium or fee. Okay, so a large sum of money will be accumulated, and that can be used to eliminate the risk. But of course, there is an issue of Sharia compliance, because not all insurance are Sharia compliant. Okay, so that can be a matter of discussion later. So in case of insurance, you understand it is not a free method. Definitely, the insurance premium is a cost. Okay, but when there is a very big negative outcome, it can pay off. It can make you free from the big loss. Okay, exposure to the big loss. Now another technique of managing risk is operating practices. You operate in a way that actually maintain your organization in a preventive manner. Okay, so there are countless operating practices that can help in this manner. So it can help to reduce different types of risk of the organization. In case of Islamic Bank, the Islamic Bank. Another one is related to the financial risk, that is deleveraging. That if the organization borrows a lot of money, take loan, a huge amount of loan is taken. In that case, what happens? The organization has to repay a very big amount of financial a very big amount of money every period. So that becomes a financial burden, a financial obligation. So this financial obligation can create a problem when your business is not good. Okay, maybe you may not be able to repay the financial obligation from your regular earning. Rather, you have to pay it from your what should I say, from the sale of your asset. So that will reduce the value of your business, the size of your business, so which is not good. Okay, so and one way of reducing this financial risk is to reduce your debt, which is called deleveraging, because financial debt is sometimes called financial leverage. So reducing the financial leverage, that means reducing the borrowing or debt, is called deleveraging. So that can be one way. That can be one way of risk management strategy. Actually, uh, actually, business organizations will use combination of all these methods, because not one single method can be foolproof for every type of risks. Okay, so you will see that a business organization sometimes is using diversification, and it is also using some kind of hedging for some kind of risks. Sometimes it is using insurance. Operating practice, they are maintaining a very good operating practice. They are also deleveraging. Okay, so a combination of all these methods are usually used by different business organizations, and in case of Islamic Bank as well, definitely these are very commonly used risk management strategies.